Welcome to the Homeward Bound podcast by the Mortgage Guys, your ultimate guide to navigating home buying and mortgage lending. Whether you're searching for your first home or settling into your forever home, we're here to make the journey simple, clear, and exciting, helping you secure your dreams one home at a time.
Hello and welcome back to the Mortgage Guys, the Homeward Bound podcast. We're grateful for you guys to be tuned in today and here with us. And Kyle Torgerson is here as usual, and myself, and we're going to be talking about a topic that we've been wanting to talk about for a long, long time that really ties right into what we deal with, and that is credit. And how long have we kind of been wanting to get at this? Months and months?
Yeah, I'd say since we first kind of thought about this whole episode or what we're going to do with this podcast is answer those typical questions that we get every day.
Yeah.
And that credit question comes up. That's one of the biggest hurdles that people think they have that we'd like to help our consumers and people that listen to us especially understand that they probably have a better leg up than they really understand.
Yeah. I mean, honestly, credit, let's face it, in our line of work as lenders, it's the gateway. It's either you're going to be the door to opportunity to get involved or it's going to be the door that slams shut. But it's not necessarily always a slam shut. And Kyle, we've been wanting to get a professional to come in here on this show, and especially this episode that is specifically a credit specialist that works with credit repair. And with that, I'm going to go ahead and introduce Jared Barnes, who's here with us today. And we're grateful to get you on here to be able to talk about this, Jared. And I'll just say really quick, you're the owner of 10 Credit, correct, here in Southern Utah. Why don't you tell us a little bit about 10 Credit yourself, what got you into the credit repair profession?
Yeah, perfect. So there was an event that happened many moons ago. You probably remember the 08, 09 Great Recession.
Yeah,
I remember.
So we all remember that. Who could forget? That's what got me started in this industry, mainly because we got absolutely creamed through that period of time, like a lot of people. And, we had our own mess to try to clean up and try to sort through. And that's what ultimately led me to doing this. As I was navigating my way through figuring out what to do with some of these charged off accounts, collections, different things that were hitting us all at once, all of a sudden, credit became one of those topics that was just really on the forefront of my mind.
Yeah.
And, there was a series of events. I purchased a course that, a big online marketer had put out that one of the sections of the course was a section on credit. And I'd never learned anything about credit. It's not something that's taught in school. Mm-hmm. And so it was my first exposure to, really how the credit game works. And so it was like, because I was right in the middle of this mess, dumpster fire, it was just really on the forefront of my mind. So I learned as much as I could about credit and figured there's probably some other people out there that, are navigating through the same stuff that could use some help. And that's kind of what started it. And, that's what's brought us to here. Yeah. And that was 15, 16 years ago when I started.
So probably in that 2009, 2010 timeframe, right after that 08 Great Recession that took place?
Yep. So we officially launched in 2011.
Okay. So did you find was it something that as you dove in, because you were trying to just basically handle your own issues with credit that you'd stumbled into during that thing? Mm-hmm. Did you find it interesting right off the bat? Is that something that just resonated with you, or did it take some navigating through it until it really started to click?
Well, once I went through that information in the course, it really resonated with me. It's just the information was just like, why have I not learned this before? Yeah. Because it's not taught anywhere. Yeah. We're thrown out there into the world and we just have to learn from the school of hard knocks. We're kicked out there into the world and it's like, okay, get a credit card, get an auto loan. And we just end up trying to stumble through it. And we usually end up making a whole bunch of mistakes and have to learn from those mistakes versus, if people knew the rules of the game in advance, they could avoid a lot of those mistakes. Yeah. And so a lot of it is just understanding how the game is played, plays a big part. But that's how I got started.
And I think that's kind of what we want to key in on is, the behind the curtain, a lot of things that people don't understand and know. What are common pitfalls about credit, common misconceptions. So anyway, in preparing for this this episode, I wanted to go through and find a few statistics and things that are common. And I learned some things. Some things weren't as surprising as I thought, but I was actually surprised. So the average credit score in the U.S. right now, what do you think that would be?
Ooh, I bet you probably have a closer guess than I would. I see what we see on applications that come through in our world, and I would say it's probably somewhere. I feel like it's changed. Let me say this really quick. As I go back and I look at when I first got into the lending or game at all, I started with a bank. This would have been in the early to mid 90s, and I was doing consumer loans and home equity loans. And I seem to think back there what was considered a good score back in those days is if you were at 680 or higher, it was like a good tier.
Yeah.
And now I feel like it's 740 or 760 and higher. So I don't know if the model's changed. But to answer your question, and it's a long-winded answer to your short question, I would say the average nowadays is probably 710.
Okay.
Maybe I'm high. What do you think?
The last number I saw was a few years ago, and I believe it was up close to 720 at that point. But I haven't seen it recently.
Well, dang, if we split the difference on there, 715.
Hey, all right.
You guys are there, so your beat is right on. That's pretty amazing.
Not bad.
I feel like I would have been perhaps a tad more pessimistic, but yeah, 715 is the average U.S. score. And I'd say, looking at old applications and things in my mind, that's probably about accurate there. Okay, average age for a first-time home buyer today.
This is more your department, but I would probably say the average age, 28.
Okay.
I think it's probably like the other question. I think it's something that probably evolved due to some external factors and what we've seen, and we have maybe more of those kids that are either staying on the fence, partly due to the economic issues that we're in, where home prices are higher and interest rates being a little bit higher, and it's just harder to afford it. And then we also, no offense to any potential listeners out there that might be living in their parents' basements, but we have people that maybe are living in their parents' homes a little bit longer.
Let's get them out.
Let's get them out. Our goal here at this table, we want you out. We want you to fix your credit up and come see us. But my guess, I bet you we're probably closer to 32 years old.
Okay. This one was disappointing, actually, because I initially thought the same. And it must be external influences that are pushing this, but it's now approaching 40.
As a first-time home buyer.
As a first-time home buyer. And I'd say that, I think a lot of people, my first impression when I read and saw that was like, I think there's a lot of people that are potential homeowners that don't know that they could jump into the market.
Mm-hmm.
And so, again, this is the main reason for doing this podcast, is to help people understand that you might be closer to homeownership than you really think.
Yeah, maybe some of those people that are in their 20s and 30s are hesitant and staying on the sidelines because of a credit issue.
Yeah.
Maybe they have a car that they couldn't make the payment on and they turned it in as a repossession. And maybe they think, well, I'm never going to qualify now. And
yeah.
That's kind of what we hope to shed some light on today.
Yeah.
It's interesting.
Yeah, it's interesting. So first-time home buyers make up about 21% of the nation's home purchases per year. And so it's actually declined a little bit over the last couple of years. And it's, interest rates have been higher.
Yeah.
Ever since everybody got used to the time and season of 3%, 4% interest rates. Now that we're in the 5 to 6% range, I think a lot of people feel like it's unattainable.
Yeah.
And that's the thing that we're gonna talk about today is trying to figure out how we can help people if they're a little bit worried about their credit. How can we fix that, right?
Right. Yeah. So for sure. And I'm glad that we have Jared here with us, because I think sometimes, maybe one of those misconceptions out there is like we just talked about and touched on, is that people think, especially if they've got some things wrong with their credit, it might be something that people interpret as being embarrassed about.
Yeah.
They don't want to disclose it, or they don't want to talk about it. And maybe, and let's ask you, Jared, is it something that you find when you, let's say, we get a client, and this is how our relationship works, a professional relationship with Jared here, is we get a client that will apply, and we get them through the process, and we say, you know what, your credit isn't quite there right now. But all hope is not lost. It doesn't mean a no forever. It just means a not right now. And I say, we have an individual we'd really like you to get in touch with. And that's where we make this introduction with you. So I want to ask you, what is it like when you start to work with those people? Do they have a little bit element of where they think it's way worse than it reality is? Or what do you think?
Yeah. I mean, it definitely is the case. A lot of times, not all the time, but sometimes they think, when I start asking them about their timeline of what they're looking to do, sometimes they're thinking, well, we're hoping we can buy in the next year or two. Mm-hmm. And then after looking at their report, I'm like, you might be able to do it in the next 90 days if we take the right steps. Mm-hmm. And they just don't know what those steps are. So a lot of times they have no frame to determine how long it's going to take. Yeah. And so, sometimes it just takes somebody looking in that can say, this is what can happen the next 3 months, 6 months. So a lot of times they're thinking it's going to take a lot longer than it actually will.
So, I mean, they've got to be ecstatic to hear, you might be in 90 days instead of 2 years.
Yeah.
I mean, that's got to be a pretty exciting phone call.
Yeah.
At that point.
Yeah. I would definitely think so.
So I know a lot of times in the home buying process, when somebody is thinking about, I want to go get into my first home or a home, period, I know a lot of times they start the process by talking with a real estate agent. They do. They'll go through a neighborhood, see a sign, talk to a real estate agent, and maybe in the back of their mind, if they know they have some beat up credit, they're a little bit reluctant to do so. Maybe, and I think, I'll throw it out there and ask you, Kyle, don't you think maybe the process should be a little bit different now? Maybe where, especially if somebody has those questions, they should reach out to you, someone like yourself, myself, in this industry. Let us tell them, is their credit good enough? And if it's not, before they go and, I don't want to say waste an agent's time or real estate agent's time, but let us kind of determine, how far off are they? And then get them in touch with Jared and let you work with them to get them to where it needs to be. And then we can deliver to a real estate professional, somebody that's really ready to go. Don't you think that would be the best process?
Yeah, I think the psychology is that people don't like to hear maybe not now or a no. Yeah. And so they try to bypass that for the longest time they can, get really excited about it, and then maybe, okay, gosh, yeah, we better jump in here and figure out if we're good to go or not now that we're so excited. But yeah, honestly, the best way to go around it is to talk to a professional lender. Mm-hmm. Really have them go through, and we don't have to do a hard pull on credit, right? We can do a soft pull. There's no dings on your credit. I know that's a big concern. People are really worried about their dings on credit. We'll talk about that here in a minute too. But, let us go through. And honestly, we want to help our clients. We want to make sure that they get into a home. If it's a no-go right now, at that point, we do get you a hold of Jared, but we also put together a game plan if it's income related or debt related, credit related, how do we go about getting people into homes? And that's where people should start. They should really want to dive in and make a plan first before they go shopping for a home, before they go tour some homes, before they get their energy level to that point. It's good to really see what you can fix. One of the statistics, just really quickly, that I pulled up is even if people are a good to go situation, maybe they're in the mid 600 scores, which is a doable mortgage credit score. Yeah. One of the statistics I found was that if you're in the mid 600s with that rate, and if compared to like if you're in the mid 700s, like 740 and above, over the life of a loan, it can save you over $74,000 in interest. Wow. If you're just building your credit score a little higher. And so, I mean, you might be able to get into a home, and let's do it if you really need to. But if we can take 90 days and boost a credit score, man, let's do that. Let's save you $74,000. Yeah, that's a lot of money.
I want to just say one thing, just so listeners understand. Most of you probably already do, but in our world, it's risk-based pricing, right? Yeah. I mean, obviously, the reason that the interest rate that they're going to be offered on a loan is better if you have a higher score is because it's, statistically a lower risk, right? Lower risk credit. And that's the whole reason for that, for those people that are out there. Now I want to ask Jared, one of the things we stumble into a lot is we'll sit there and when we pull credit, people will say, well, I'm looking at Credit Karma and I'm seeing this. And it seems to me, let's talk about that a little bit. I think it's like FICO score versus consumer score versus whatever it might be.
Yeah.
Can you kind of help us to understand that, the differences that might be there and why they're different?
Yeah, for sure. I mean, it comes down to the scoring model that's being used. What people don't understand is sometimes they think I have a credit score. You don't have a credit score. You have dozens of credit scores. It's all based on the model that's being used. The most popular model in lending, period, in the United States is the FICO scoring model. It was the OG from back in 1956. It was created by a couple of guys. One of them was an engineer, Bill Fair and Earl Isaac. These guys were an engineer and a scientist that they said, look, there's bureaus that have data on consumers. Mm-hmm. Now, there's got to be a mathematical way that we can analyze that data to mitigate risk and come up with some type of an algorithm that generates a score. So they are the ones that created that original FICO scoring system. Mm-hmm. And, you know, over the years, there have been different versions of the FICO model that have been released. Mm-hmm. And what happened was in 2006, the credit bureaus come along and they said, we're tired of FICO having the monopoly in the credit scoring world. And they created a model called Vantage Score. Vantage Score was created by the credit bureaus to compete with FICO. And it just never caught on in the lending world. And so the lenders' systems were all built for FICO. And so still 90+% of the lending world uses FICO. So it never took off in the lending world. So they went to the consumer world. And they partnered up with companies like Credit Karma and a bunch of others to use that scoring model through those platforms. So when you go to Credit Karma and pull a score, you're pulling a Vantage score. It's not a FICO score. It is a little bit of a different algorithm.
Yeah.
And so that's why it's different. It's kind of like, you know, I went to the doctor on Monday for a checkup. I stepped on the scales, which they have you do, right? Which is always fun. So I step on the scale and I'm looking at the number that's there on the scale, and it was a different number than I was expecting.
Yeah.
Because it was actually in kilograms. So, so I was like, sweet. No, you're 97 pounds. No.
I like that scale.
Yeah, that's what I said. So it was 97. I don't know what the conversion is. I'm about 200-ish pounds, just so you know. But so I'm looking at it going, I'm not 97. I'm 200 pounds. So it's all in the model that's being used. I'm the same weight. I'm just being measured differently by a different model.
Okay. That makes sense.
Does that make sense?
Yeah, and we deal with it so often. People sit there and because one of the questions when I'm taking an application, before I'm taking an application, how's your credit? You know, when we first talk.
Yeah. And
they'll tell, I'm a 780. And I'll ask how they got that. And it's Credit Karma. Do you bump into that all the time as well?
Yeah, you know, sometimes they're pretty close. Sometimes they're wildly different. I've seen someone say, yeah, I'm 780. I'm like, you're more like 680.
Yeah.
And I've also seen, you know, I'm 780. Oh, you're actually 830, you know? And so, how it reports. The one thing that I've seen that's a commonality between the two scores, though, is if one goes up, you know, the other one goes up. And so they trend the same from what I've seen.
Yeah.
And so I tell my clients, I'm like, okay, you know, keep an eye on your Credit Karma. If you pay stuff off and things change and you see an improvement, probably means I'm seeing an improvement too.
Good point.
There is, yes. In general, yes.
In general, yes.
There is one major difference between the two, and it comes down to like collections.
Yeah.
In the Vantage scoring model, you actually get points. You do gain points by paying collections. So a mistake that a lot of borrowers will make is they'll go into Credit Karma and it'll tell them, you pay this collection, you're going to get X number of points.
That explains a lot.
In the Vantage scoring model, you will get those points. The FICO model doesn't recognize paid or unpaid collections. A collection is a collection is a collection. It's going to hit you the same paid or unpaid. So people will go pay these collections thinking that they're going to net positive 70 points, and they go have the lender re-pull the report and the scores haven't moved.
Yeah.
And so, you know, when I say if you have things like that on your credit, which a lot of people do, collections, charge-offs, you know, just some issues like that, you're always better to get some professional advice on how to handle those versus just going blindly in and just doing what Credit Karma tells you to do or what someone on TikTok tells you to do. Have a professional get some eyes on it to tell you what's going to be the best plan of attack so you don't end up throwing money towards something that's not going to help.
So sometimes you could be kicking a sleeping bear and it could just make the whole situation much worse.
Yes.
That's not
and
good.
and that's the other factor is if it's an old enough collection, if you have just one collection on there that's 5 years old, 6 years old, and you pay that collection, there's even some data out there that suggests that may even lower the score because it can bump the activity up to more recent activity, which could even drop your score to pay that collection, which makes no sense.
It makes no sense.
But
Yeah, I've seen it happen.
It is what it is. I've seen it happen too, and it's unfortunate. But
In your experience with those situations, because we've seen that, in mortgage, if someone's got a collection, there's a lot of times where they have to satisfy those before they can get a home. Mm-hmm. A lot of people don't know that. And so listeners, if you got collections, talk to a professional. They can help you get them taken care of if you're shopping for a home. But what is typically the time frame if someone's got an old collection, they didn't pay their AT&T cell phone bill, or they have an $85 collection, they pay it, they get a little bit of a black eye. I mean, what's typically the recovery on that from what you've seen?
Good question. So there's a few things when it comes to payment history that it takes into account. Late payments, collections, all these kind of things. So number one is recency. How recent did the event happen? That's a big one. So like if you have a 30-day late that just happened last month, even though it's only a little 30-day late, because of the recency, it's going to have massive impact. Like as an example, let's say you have a 6-year-old bankruptcy on your credit. I mean, bankruptcy is the worst thing you can have on your report, but it's 6 years old. And then you have a 30-day late on your auto loan last month. That little 30-day late will likely have as much or more impact on your score than that 6-year-old bankruptcy it's having.
Wow.
Because of how recent the activity. So recency plays into that. The next one is severity. Like how severe was it? Was it 30 days, 60, 90, 120 on late payment? And then the last one is frequency. How often was it late? Was it just late one time? Was it, are you peppered with lates throughout your entire credit history? All of that plays into the scoring algorithm. So a collection kind of falls under those same parameters. Maximum impact the second it hits the report, less impact as you move forward. But as long as it's present on the report, it will have impact for the full 7 years that it reports.
Wow. And is a unpaid charge-off versus a collection account that's unpaid, are they similar in the impact there? Is more just, are they kind of categorized about the same?
Yeah, charge-offs and collections are very similar because they're in that severely derogatory status.
Okay.
Where it becomes a little bit different in how they impact is what type of charge-off it is.
Mm-hmm.
Is it a loan charge-off or is it a credit card charge-off?
Okay.
If it's a credit card charge-off that has a limit and a balance, and it's with the original creditor, it's still going to factor into the credit card utilization, which that credit card utilization, how much you're using of your available limits on credit cards, even a charged off credit card, as long as it has a limit and a balance, it's going to be factored into that calculation, that utilization. So still going to impact the score from the derogatory standpoint, but also the utilization standpoint.
That's interesting. I think back to different situations over the years that I've seen on, some of the unfortunate files when somebody applies and their credit might be lower, some of the lowest I've seen. And typically after listening to you just say that, it tends to be those people that maybe went through a real rough spell, 2-3 years where they just ignored everything. And they got those things from 30 to 60 to 90 to 120 plus. And then they were maxed out credit cards. So that usage was maxed. They got way behind on multiple accounts. And then at the very end, after that festered for about a year or two, then they declared bankruptcy. So you have all of that stacked upon one another. And then all of a sudden you get that high 480 score, 510, whatever it might be.
Yeah.
And it seems like that makes a lot of sense in what you just said based on that.
Yeah.
That's interesting. So as far as let's talk a little bit more on usage, because I seem to think that in our business right here, look, we get a person that applies and we approve them and things are going along fine, and we can see that the biggest needle mover quickly, aside from missing a payment during the loan process, is when they go and rack up a credit card. When they take that credit card from 30% usage and all of a sudden they go buy something in the home process and it goes on their credit card, and it not only is a new debt or additional debt, but it actually gets that usage above 50%.
Mm-hmm.
I mean, is that something that can quickly drop their scores by, we've seen it moving points. What kind of points can they expect if they go from 30% usage to 60% usage in 1 month?
Yeah, good question. Like most questions that are geared around credit, the answer is always depend. It depends.
Yeah.
Because it depends on their unique file and what their overall aggregate utilization is. So, but if their aggregate utilization goes from 30 to 60%, yeah, that's going to have, a pretty major impact on the score. Just generally speaking.
Yeah. And in our world, I mean, obviously we have different, if credit scores are at 640 versus 680 versus 720 versus 760, those are all those stair steps we talked about, that risk-based pricing. We might already have them approved at a certain and lock the rate in, and then that happens and all of a sudden we can't keep that rate. Now we have to adjust that rate.
It goes the other way too, though. I mean, if we lock someone's rate and we say, hey, by the way, your credit's at 680, if you pay these few cards out or down,
mm-hmm.
we can do a rapid rescore, and then we can actually improve your rate or reduce your points or whatever it is. And so
yeah,
it's a simple way to, I hate to say, manipulate your credit,
yeah,
but for the good or bad, but at the same time, instant results.
Yeah.
Yeah, that utilization is definitely something you want to pay attention to. It's in a pretty major factor on the credit score. 30% of the score is utilization in general, and most of that is credit card utilization.
And that's utilization is probably one of the quick fixes in your business, I'd imagine. Mm-hmm. You can say, hey, get these cards paid down. If you have one that's sitting at 80%, then you have these two at 10%. Maybe if you get all of them, but to be below 30%, you're going to be better off. You can kind of shuffle things, or else just pay some down.
Yeah, utilization is a great way to manipulate the credit scores in the short run. It's one thing that you have total control over, to where you can move the needle on the score. And there's other tricky ways that you can do it too. Sometimes you can take out, this is a mortgage podcast. You may not want to take out another loan, but you could take out a personal loan to pay down utilization in a pinch.
Yeah.
If it was killing the deal and they're not able to get approved otherwise, and they don't have the cash on hand to pay it down,
sure.
A strategy is to take out some type of a unsecured personal loan or secured, and use that money to pay it down, because the personal loan isn't going to be factored into the utilization like a credit card is.
Because it's not revolving.
It's not revolving. So you're going to be moving it from revolving debt to installment debt. Mm-hmm. And, you're accomplishing the same thing. The only difference is you are adding another line item on the report, another trade line.
Yeah.
And, there may be a little bit of a minor impact on the score due to that, but it's like a minor impact, like a small step back to take a huge leap forward.
That makes sense. And that, for us, I don't think that's something I ever recommend, because we're just programmed as mortgage lenders. Hey, don't take on any new debt. But let's say they have a debt ratio, back end ratio that's only 36%. But the credit score could really use some beefing up to get that next, improvement on the interest rate. If that fits, why not?
It's going to be more of a case-by-case basis, to make sure that it doesn't mess up the DTI and any of the other numbers you guys are shooting for.
Yeah.
But it is a strategy that can be used.
Now, let's make it clear, we're not advocating for people to get more debt during the mortgage process.
Yes. Sorry, guys.
Yeah, hopefully, if you're watching YouTube, hope there's a banner right here that says that it's flashing.
I always go back to the conversation that we initially had about your client that went and bought a Corvette.
Yeah, let's not do that.
Right before closing, and my client that bought a big F-350 right before closing, and so.
Yeah. This strategy is not an increase in debt; it's a movement of debt to a different product.
That's true.
Good clarification.
That's true, because you're taking that new debt is replacing revolving debt and pulling it into the
Yeah.
installment column.
It's the same debt. You're just changing how it's reported, so it's going to affect
Yeah.
the score.
It doesn't come with a shiny new car, but that's
Right.
okay. They can do that after they get in the house.
Exactly.
That's right.
So as far as I have a question for you, like we get some people that unfortunately do have some of those unpaid collections, or we see a lot of these accounts under dispute. That seems to be a big one. This has been disputed, and let's say that we've already talked to them about utilization. Their utilization is not the issue, but they have some derogatories out there, some majors or whatever that might be collections or charge-offs or something that's been disputed, and we turn them over to you. Is that a long-term? I know it. Again, it depends.
It depends.
It depends, but I mean, is that something that can take months, years? I mean, how long does it take to typically clean up somebody if they have 3 or 4 accounts that have been charged off? Or do you negotiate for a lesser amount sometimes? Do you make calls? Do you help them make calls to creditors? I mean,
We don't do debt settlement like that. We are a credit repair firm, so we actually go after, the law. We use the law, the Fair Credit Reporting Act, to get items, reporting correctly.
Cool.
If something is obsolete, incorrect, unverifiable, any of those types of things, those are the things we want to do. Try to get them removed from the report. We're not going to negotiate the debts.
Okay.
But yeah, those types of clients that have those collections, charge-offs, things like that, how long it takes is going to depend on their unique file.
Mm-hmm.
The most extreme example that I've seen happened within the last year, where we had a gentleman that was at like 575 that went up to like 750 within 30 days.
Wow.
We have those kind of examples. Those are the extreme examples, and that doesn't happen to every file.
Mm-hmm.
There's some files, if they have a bunch of recent late payments on open accounts,
Mm-hmm.
even if we get some of those collections charge-offs cleaned up, tidied up, their pathway to a higher score is still going to be a lot slower because it goes back to that recency again, how recent that activity is still going to anchor them down to a degree while we're cleaning things up. So it all depends on where they're starting from and what's on that credit report.
And I guess that's, again, to your point where we started, building a plan before you really get serious at looking for a home.
Mm-hmm.
If you've got 90 days to 2 years to fix your credit, man, we better just get started on that first. And especially if you miss some payments or something like that.
And
that
knowing
plan's
how much
important.
impact it has, like you just said, how much money people are just throwing away by just getting into something at a lower score. If you've got the time, you're better off to take a look at it now, and let's optimize the file and let's get you as high as possible so that when you're ready to pull the trigger, you're going to get the best rates and terms that you possibly can. People just tend to wait too long.
Yeah.
And they wait until it's like, okay, it's a month before we're ready to go apply. Now I'm going to look at my credit and see what needs to be done. And if we just dial that back and say, let's start today and give yourself that time, even though it doesn't have to take forever, give yourself enough time to make sure you get it as optimal as possible. It's going to make a huge difference down the road.
Yeah. I know that, and I can think of a few different examples where you've helped my clients over the years. And we were talking about one just a little while ago, young couple that just had during the loan process, they just had their first baby, just got married recently, and they had some things that were kind of a little bit ignored. And they had some of the utilization and usage you talked about. They had just some different things that were holding them back. And I remember I got them in touch with you, and I want to say it was about, within a 6-month period, like 4 to 6 months, and they were lendable. That was one that's, for me as a lender, I think as long as we know that, hey, this can be 4 to 6, maybe 12 months out, that's a doable deal. We're here for you. We're here for the long haul. Let's get you there. But these folks, they were in a brand new home that they had built. It's 6 months after talking to you, which is a cool thing, and it's always pretty gratifying. They're really thankful because they, weren't really sure where they could move with their credit, and all of a sudden, boom, they're in that house with the new carpet smell and the new paint, and that's as good as it gets, right?
Yeah.
A brand new house.
Yeah.
So,
I mean, people they don't know what they don't know.
They don't.
And so a lot of times they'll stumble onto something and they see online and they just get really confused and don't know where to start.
Yeah.
And a lot of times just having somebody to sit down and map out for them, this is what we need to do first, this is what we need to do next, and just give them a step-by-step plan. And this couple that you're talking about, I mean, they were really good at doing their part. We did our part. They did exactly what I told them to do. And that's why they got the results that they got.
Yeah, and then I think you called me, you called me regularly on it every month or so saying, okay, here's where their scores look like they're getting to, and I think in 2 more months we're going to be here at objective, and they were. And all of a sudden we were ready to go, and the house got finished, and they got moved in. It was a wonderful thing. So, and then another client I want to touch on real fast, and this kind of opens up a different thing I want to discuss, is there's a difference between bad credit and no credit. And you helped a client of mine that was getting into a home about 3 years ago, I want to say. And he was young and he had very limited credit. And, you brought up the idea of maybe being a signer on a seasoned credit card, that with a relative or whoever they may know that's willing to do that. I couldn't believe how drastically and quickly that improved his credit situation. I mean, it jumped up so fast, and he went from being non-lendable within 2 months. I mean, we were closing on that loan just from that one strategy that you gave him. So going along with that, when you have somebody with no credit, and I know for using that idea that you gave me on that file, I did the same for our son when he was serving a mission, and it did wonders for his credit at a young age. What can any parents out there that might be listening right now, if they've got kids that are in that 17, 18, 19-year-old range, and they want to give their kid a leg up so that they're ready to go, so they're not going to fall victim to that 40-year-old first-time home buyer, so maybe their kid can be one of those at 25 years old. What can somebody that's a parent do for their teenage kids to help get them started?
Yeah, good question. The first thing is you want your kids to establish primary credit. So they are going to want to get their own credit card or two open, an installment account of some kind, because they want to get in file with the credit bureaus and start to establish some primary credit of their own. The things that the parent can do to kind of help with that is, if you do have existing credit cards that you've had for years, that are in good standing, you obviously want to have a lot of caution with this strategy. In good standing, utilization tends to always be in check. You're not maxing the cards out, things like that. You could add your child as an authorized user to those cards, and all that good payment history, the age of the accounts comes with it. So you're basically giving them a huge leap forward by adding that additional age to their credit file. So it's a great strategy. It's something you can do to help your children if you have cards like that.
Sure. If the parent has
If the parent has cards that are good candidates for that. It could be a grandparent, could be a sibling.
Yeah, aunt, uncle, somebody. It doesn't necessarily have to be immediate family member, correct?
Correct.
Okay.
Wish my parents would have done that. That would have been awesome.
Yeah. So really, I mean, the parents could do the right thing for their kid and do something like that if it's possible. And then in addition to that, maybe co-sign on a small installment loan for I know for us, we did that for our kids with some very reasonable vehicles. Nothing super fancy, just something later model used vehicle that works. And then it's amazing how they go from having virtually no credit to being mortgage ready just with a few little strategies that you've helped me to see. And that's awesome for especially anybody out there that wants to do this. And unfortunately, we have some families that are the cash people, right? The ones that never use credit cards and never do anything, and they raise their kids the same way, and they think, stay away from debt. That's true to a certain point, but in our day and age, we need to have some sort of debt in order to be able to establish that credit score that's needed to be able to get credit.
Yeah. Well, and the thing is that building credit doesn't always equate debt.
Yeah.
You can build credit without taking on a bunch of additional debt. You can get a couple credit cards open. You don't necessarily have to put debt on those. As a matter of fact, the way I recommend people use credit cards out of the gate is just use them to pay something you were going to pay anyway. We all have these recurring payments that we're paying every month anyway out of our debit card. Take something like that, put it on your credit card. Your Netflix, your Hulu, your Amazon Prime, Spotify, we've all got them. Take one of those, put it on the credit card, and only use it for that. When the bill comes, you pay it off. That way you're not going into debt, you're not paying any interest, you're just changing the method of payment for something you were going to pay anyway. and it's allowing you to build credit at the same time. There's also some really cool installment type loans that are not necessarily loans, but there's products for credit building that don't involve debt. I'm not going to go into all of them, but there's some really cool ones like that. So you don't have to necessarily go take out a loan you don't want or need. It's a credit building type product that allows you to build credit without debt. So you don't have to go into debt to build credit.
I've seen sometimes that utilities, you can self-report, your cell phone bill, your gas payment, your electrical payment. And so we see those sometimes on credit reports.
Oh, yeah.
It's amazing what people, if they're trying to boost their credit, reporting those self-report things are great. And
yeah, and that works really well. Like, you have the Experian Boost where they will add those utility type things. So people will do that. Those work really well for people who have young files or maybe thin files where you don't necessarily have a lot of credit. If you're like Dave and he has a very established credit profile that's broad.
He just called
I'm
you
old,
old.
right? Because I'm the one with gray whiskers. Gray whiskers equals old. Established credit profile.
Established credit profile.
Moving on. Yeah.
These guys are finding some really creative ways to say I'm old. Before we even started airing this, they already had a few jabs. Even Logan over here taking the video, our video guy, he was even finding very creative ways to call me old. But anyway, back to your point.
Established credit. That's where we left off. Yeah.
Yeah, I forgot where I was even talking about now. I was too entertained with what you were saying there. What was I saying?
But if somebody has, established credit profile.
So somebody has a long established credit profile that's broad, you got a bunch of open accounts, and you go do the Experian Boost and they add some utilities, you're probably not going to see much of an impact because you already have a lot of good established stuff.
So it's good to do for somebody that's got a very limited profile or not a profile at all and they want to get going.
Yeah. I mean, there's no reason, not to do it for anyone.
Right.
It's only going to help. But I'm just saying, don't expect to see miraculous results if you already have a very established file.
Yeah.
I'd say you probably ought to be paying your utility bills on time too, if you're going to add them to your credit profile.
Yeah. Well, that's the good part is they only report them if they're positive.
Oh, that's something I did not know.
Yeah, they don't report any negative on that stuff.
Only the upside.
They'll only
there,
pull in the upside.
I like that. That's really cool.
Which is rare.
So that's awesome. So basically, people that don't have credit, it doesn't always have to be get a cosigner, a parent has to be a cosigner, or somebody on their loan. Within just a matter of 30, 60 days, it could be possible for them to be able to have that credit history, doing the right things to be able to qualify.
Yeah. And I will say, I mean, for a brand new child starting out that's 18 years old, that's just starting to get credit, if they don't get on to an aged credit card like their parents, then it will take them they'll take them 6 months in order to start to generate a FICO score.
Okay. Makes sense.
If they are able to get one of those authorized users, then they can get a score sooner, but it requires accounts that have at least 6 months of history before FICO is going to score them.
That's awesome.
That's another big difference between Vantage and FICO, because as long as you have something reporting, you can go to Credit Karma and you're going to see a score.
Oh, and we bumped into that. We've had those borrowers. I've got a score. Why do you say I don't have a score?
And then they come to you and they're like, why can't you guys get a score?
Tomato. It's just two different things.
Two different things.
Wow.
The other question I had come up yesterday, in fact, is, there's 3 bureaus that we pull from on the FICO, and not all the scores are always the same. And a lot of people are really confused, like, what do you mean you're going to take my middle score? Aren't they all the same? And it takes a minute to explain that, but ultimately, and correct me if I'm wrong, it's because not all creditors report to all bureaus. And so
that is part of it, yeah.
Explain to me, because I'm curious too.
Yeah, so that is part of it, is because you'll have some accounts that only report to one bureau and not another.
Mm-hmm.
That's one part of it. The other part of it that for some odd reason in mortgage lending in particular is that they pull a different bureau or a different FICO model for each bureau.
Oh.
So they're not even operating off the same model for each bureau. With Equifax, it's Beacon version 5 that's pulled for mortgages.
Seen that.
For TransUnion, it's version 4, and Experian version 2.
Yes.
I don't know why, but Fannie Mae and Freddie Mac, they're the ones that dictate what models are used in mortgage lending, and for whatever reason, those are the models they picked for those bureaus. So when you look at your credit report, it'll tell you, you'll see Beacon 5 for
I read that.
Equifax.
Didn't have a clue what that meant.
Version 2, version 4. They pull different models for the different bureaus for some odd reason. But so we're having this conversation today about the FICO model. So a lot of the information we're talking about is as it pertains to mortgage lending today. But there are things on the horizon where things are going to be changing. They have established that they are going to be moving, or have the ability to move to other models moving forward. You're going to be able to use, for the last probably 20 plus years, those versions that I just mentioned, those are the models that have been used in mortgage lending. And they haven't veered from it. They've been stuck. All the systems are built around that. And that's kind of why they've stuck there. Using those models. But they have announced that they are going to start to allow lenders to use FICO version 10 and 10T, which is the newest versions of the FICO model, and also Vantage Score 4.0.
Oh,
saw
So
that trading.
they are going to start, they are allowing lenders to do that, but just because they're allowing it doesn't mean they're going to. I haven't seen anyone that has leapt to that yet, but that's something that's on the horizon. So eventually we may be talking more about Vantage scores.
That makes sense with those Beacon versions being different, which would really explain why when we do the what if simulator in the past, it says, okay, if you pay this credit card off or move this debt from this to this, your scores will change like this, and it will have Experian, TransUnion, and Equifax all having a different impact, a result from, or an impact from that movement that they suggest. And that's exactly why, I guess, because those beacons are different.
So you're going, it should impact exactly the same, but it doesn't. It's
They're
all different. Yeah. And there's one major difference. So this is kind of a little bit deeper than we need to really go. But in mortgage FICO scores, if all of the credit card balances are at 0, you're going to net a certain score. If you have a $10 balance, at least a $10 balance on one card, your scores will be about 10 to 15 points higher with 2 of the bureaus.
Only 2 of them.
TransUnion and Experian. That Equifax Beacon 5, for some reason, you don't get those points.
interesting.
It's usually just TransUnion and Experian.
Wow.
I mean, the one good thing about having different models for each one is when we're running a what if scenario, we get to say, well, we're going to pick this one because it's higher. So,
yeah, true.
You know, it gives us some options sometimes.
And we only do, yeah. That's pretty interesting. I think that that's one of the biggest takeaways we can do here with people is just to know, again, whatever your score is right now, it can be fixed, cured, modified, amended, whatever we want to call it. I don't know what the term is, changed. That they're with the right movement, the right suggestions, the right plan, and following out that what you will tell them, it can be improved, and it can do it a lot faster than what they might fear.
Yeah. As long as the person has at least a level of financial stability, then they have the ability for things to improve. It's where people are underwater. They're not able to kind of keep up on things that it's impossible to move the needle if there's new negative stuff continually hitting the report. But as long as there's that level of financial stability, we can start to move things in the right direction.
That's good.
That makes sense. Well, the good thing is that you are local. It's we got a 435 number on your card, which is really nice. It's not the credit cubicle I think you were talking about before we even started. It's not someplace back in San Diego or wherever. It's nice to have you local. It's of course awesome to have you on our podcast and have your expertise to lean on, and we're excited to lean on you some more.
Yeah, I recommend anybody out there, if you're sitting there and you're one of those people that's been a little bit apprehensive and you're sitting there thinking, you know what, I'm kind of maybe even too embarrassed to talk to a lender first, but you really want to see where you can get to. If you don't call us first, or a lender first, the information, for Jared and 10 Credit will be right here. It's going to be on the screen for you to see. And then, Jared, why don't you just go ahead and, because some of these people might be listening on Spotify. There might be an audio rather than video. So why don't you just, again, give a little audio commercial for yourself, if you will, so they can get a hold of you and know how to reach you.
Yeah, for sure. So I would recommend, as a first step, is to we do a free consultation.
Cool.
And you can reach out. We'll schedule that. We'll jump on a Zoom. We'll go through your credit report together. No need to be embarrassed, because I sit here as someone who has had everything on a credit report that can be there, except for a bankruptcy. I haven't done that, but everything aside from that I've had on my credit. So no need to be embarrassed. It's a judgment-free zone, and we'll help you map out exactly what you need to do step by step. To reach me, I recommend just contacting me directly. My cell phone is 435-590-6942. Website is tendcredit.com. And yeah, just reach out. Let's do a no obligation free consultation and just help you map it out. Even if there's not something I can do for you personally, at least you'll know coming out of the consultation exactly what steps need to be taken.
That's awesome.
And let's get people in a home and make sure that they're before their 40th birthday.
Yeah.
Way before.
Yeah, and if it's it's not necessarily it's a no, it just means not right now. Let's get you fixed up, get them in the home, and it can be a lot sooner than you think. So with that, Jared, thank you so much. This has been
Thank
great.
you guys. Appreciate it.
If there's no other comments, we'll go ahead and wrap this up. And thank you for listening, everybody. We're grateful for you. And one last thing, if you haven't already, please subscribe, please like. It helps us out immensely. It helps us get this information out to everybody. And as always, thanks for tuning in to Homeward Bound with the Mortgage Guys.